Hi everyone, and welcome to this live coverage. As usual, I will share with you a few minutes to take a look at what the week may bring ahead. Okay, so let's start taking a look at the economic calendar uh, and see what we should care of these days. Right? We are back from a long weekend, and stocks behavior is getting some influence over the forex market, but I guess that the market is slow mode today also because we are waiting for Fed's speech in the American afternoon. Lately we have been getting mixed messages coming from the Fed, as after a really dovish statement mid-March, we had plenty of Fed officers uh, pledging for a rate hike, pledging for remaining in the tightening path, and even opening doors for a rate hike as soon as April, which seems a bit overranked at the time being for me, guys. I don't expect that. The most we can get in April, it's I don't know how to say this, but maybe a more hawkish statement than the one we had before. And again, some clues pointing for a probable rate hike, but I really don't expect any more. If they do actually rate hikes in April, that will shake the financial worlds, but that's something we will discuss later next month. Okay, and following with the fundamental calendar, we have German inflation on Wednesday. Honestly, German inflation has been not a big market mover lately, but indeed, if you take a look at the calendar, we are expecting better numbers for March than the first. These are revisions, right? The first estimate. So that could be a bit of good news for the euro, but not enough, I believe, to trigger a strong movement. Beware of that. Anyway, you know that the accumulation of positive data ends favoring the currency. So it's worth to remind this. Anyway, I do believe that the main attention will be focused in the ADP employment report in the US. This is a private survey. It's about private sector employment, right? But the market is usually taking it as a lead of whatever the payroll may bring on Friday. And no doubts that will be the start of the week. It's expected slightly lower, but between the 200,000 levels, so actually not much to say. Anyway, if the number is as expected or below, the dollar will probably suffer, okay? Uh, what's next for me, it's not German unemployment. Really, the employment in the euro area has not been a concern for this last year or more. And I believe that the main attention will focus in the GDP in the United Kingdom. We are getting little data from UK lately, right? So the pound is being driven mostly by dollar self-strength or weakness, alongside with fears of a probable Brexit. We are 3 months away from the referendum where the people will vote whether if they prefer to stay or leave the Euro Union. But still, the market is quite focused on that. I do believe it's a bit exaggerated, but still it's what the market thinks, what words watching, and not what I think, right? Anyway, as you can see, we're not expecting big revisions in here. The forecast is pretty much in line with the previous. That should not be any kind of surprise. I will be looking for deviation in these numbers. If we had a strong number and given the latest recovering pound, the pound will probably continue rising. But if we had a negative number, I do believe that we will have a bigger impact because the market is looking for reasons to sell the pound rather than buy it, right? And using the Brexit as excuse also. But anyway, a bad reading would probably trigger a sharper move towards downside than a good reading trigger an upward move, okay? Later that Thursday, we have the ECB minutes of the latest meeting. Actually, I don't believe that this will be much of a market mover. We know everything that the bank announced it. Sorry, And I don't expect much surprises from here. Bank of England Governor Carney, on the other hand, will be pretty much relevant because, again, the market will be looking here for clues on how's the sentiment towards Brexit and until the economic outlook, okay? And of course, the start of the week will be the US unemployment data for March, right? Uh, uh, I do believe that these reports, manufacturing and non-manufacturing PMIs in Europe and China are relevant, but the market is due to little reactions usually to this kind of data ahead of payrolls, right? Payrolls will be the start of the day. As you can see, we're expecting a decrease in jobs creation to 42 against 205. 4.9, the unemployment rate, it's really, really low. Uh, as I said many times, many times, Fed decisions rest in two legs. One is employment, the other is inflation, right? So for the Fed to rise rates, they need strong employment and rising inflation, or at least closer to the 2% target the central bank has. Employment has been doing really good for over 2 years now, right? We are 200,000 new jobs a month. The unemployment rate, it's at record lows. So what I'm trying to say here is that employment has not been a concern for the Fed for over a year already, right? The main problem in the US are inflation, and in this particular case, we may get some clues um, from wage, right? Wage data within the employment report will tell us if the people is starting to gain more, and that will mean they will probably spend more, and therefore inflation will rise. So at this point, and this last month, um, the earnings, right, are far more relevant than the employment headline number that always rocks the market. Right? Anyway, if we had a downward revision to previous numbers or unemployment rate rising and then the headline reading below 200, we will probably see the dollar suffering a bit. Okay. Anyway, let's go to charts and see what the market has to offer. Give me a second till I change my hi. Okay, here we are. Let's start taking a look at the euro, right? I was taking a look at the price behavior. We have plenty of holidays, and that has left price directionless alongside with technical readings. But what I find pretty much relevant these days is that the fact that after this is the Fed rally, right? The Fed rally, latest FOMC statement rally, right? And after that, the pair has been consolidating around the 61.8% retracement of that rally, right? And then when the market woke up again yesterday, and the pair rally higher, right? So it's pretty relevant. I know the range is taking price outside of the extensions, but anyway, we are now above the 50%, and the 38.2 of that rally is around 1230. So I do believe that that's the first resistance. That's the level to beat right now to see the pair getting more bullish, a bit more of support, right? Up to this region, 1280, 1290, where it's still plenty of time. And if we take these highs, we can go back to our 3030. I do believe a bit below this 3040, right? It will be enough for the pair to break above 1330, sorry, to run up to 1375, which is this year high, okay? And okay, there we are. Anyway, back to the small chart. On the other hand, the pair has found some buyers around 1140. I do have that there's stronger support around 1120. I have repeated this multiple times. If you take a look at your charts, historical charts, you will see plenty of intraday high on those around the level from, I don't know, a couple of years already. The pair has been there, meeting selling interest or buying interest depending on where the pair is for most of the last year and even this one. So I do believe that's the critical level. It's sort of a line in the sand, because if we take 1120 towards the downside, the pair can pretty much go back to 1040, 1050, which is another strong static support level with not much in the middle, to be honest. And if we lost 110.45, then we'll probably return to the mids 900 and back into consolidative more. Another thing that I don't find relevant for the euro. Okay, there we are, weekly chart, right? Remember that the key level towards the upside is the 1460 region, right? Because if you take a look at this chart, it has been below it pretty much for all of the 2015 year and this one, right? So I would like to see the price breaking that level to talk about long-term bullish rally. We are not that far away, 250 pips. It's not like a word, right? But anyway, it seems way too much for the pair lately to move 250 pips in one directional move without correcting it quickly, right? So I do suspect a lot of stops above that level, and that's the level I'm looking for a breakout to confirm further advances. Okay, for the pound, I do believe that the trend is still bearish. I do see some higher highs being posted this March, but still, the pair reached the 45 region, a very strong psychological resistance level and retreat sharply from it. Now we are back towards the upside. This latest decline, we have corrected 50% and we're struggling in there. The chart, the intraday chart, is telling me that there's an upward potential in here, right? And that the pair may run up to 14,340. This is my first resistance today. We have a dovish Shalin. I do believe that it will probably reached, right? But yet, if we close the day above this level, I would expect a rally further towards this region, 44.20 or so, for the upcoming days. I still expect sellers to surge if a pair reaches 45, right? At this point, I would like to see a break below the daily low around 41.95 or so, 41.90. Confirm the bearish continuation in the pair and see it retesting the lows we had around 40.50. We have a couple of lows in there, this region, right? Daily ones. So I do believe it's a critical support, and if we lose it, we'll probably sink back towards this region, 38.30, right? Without stalling around 140, to be honest. When it comes to the OC, it has been quiet right after this long bullish run. Market talks are okay, it has been too much, maybe it's time to retreat, but honestly charts are not telling much about that. So far the pair has found support around just the 23.6% retracement of this bullish run, so it's not really significant. However, this daily chart is also telling us that the bearish pressure is mounting. The pair is struggling, the price struggles around its 28 simple moving average that anyway holds bullish slope, while the technical indicators are trying to cross below the midlines, but there's not enough bearish momentum in the air to confirm a downward move, right? So it's still a bit reluctant around this one to sell. I still believe that dips could be taken as buying opportunities, but I will keep a close eye to commodities, because if oil and gold continue falling or resume their previous bearish momentum, the risk in the OC will turn further lower, right? Anyway, keep in mind that even if we fall down to 73.50 or so, the 74, right? The bullish trend won't be really harmed, and it could be understood as a corrective movement, and even more, the pair can bounce and recover towards fresh highs. I still believe we are going to see a 77 to 78 in here, particularly, of course, if the Fed remains on hold, right? That's the only thing that I can see the Fed being more hawkish and raising rates. That's the only thing I can see as really bearish for the OC. I believe that the bullish momentum is still there somehow and will probably prevail, okay? And for the shorter term, the pair has been struggling around 75 without finding much direction. We have some previous lows and today's high in the 75.70 region. So I could say that that is our first resistance. in the short term, right? And if we take it, we can go back to this 76.30 region, which is the next en route to this highs around 76.80. Okay, we take that high, then as I was saying, I would expect 77, 78 levels to be reached, right? And of course, that Fibonacci and last week low, it's the level to watch towards downside, because if we take it and the price moves, I don't know, maybe 10, 20 pips below it, right? To confirm the break or even open a 4-hour candles below the Fibo, then the bearish continuation seems more likely in the pair, right? And we will probably go towards that 73.80, 74 region I was talking about a few seconds ago. The dollar Japanese yen, it's doing quite a nice recovery, but beware, guys, that today is the 8th consecutive day that pair rises, right? The advance has been shallow. We have added like 20, 50 pips a day, not really much, but it's the 8th day we go higher in here, okay? So it's due to a negative close. Someday between today and the weekend, I could expect some bearish corrective movement in here. And I won't be surprised if that happens today, right? Anyway, what I was thinking is, ever since the Bank of Japan introduced the negative rates, right, the pair has plummeted over 1,000 pips, a merely recovered 300. Right, so one wonders why, after the introduction of negative rates, the pair is not on 120, for example. Right, so that's what I'm considering in here, the most 125 or so. But anyway, the strong plummet is keeping the long-term trend towards downside, particularly because right now approaches towards the 1440 region had been taken by the market as selling opportunities. Okay, so that's the level. Anyway, I do believe that the 15 region, right, 15 level is the one to beat, right, to talk about a U-turn in this bearish trend. In the meantime, the pair has been consolidating in between the 15 and 110, so we are getting closer to the roof. Maybe consider a sell if we approach higher. 1440 or so could be a nice trading opportunity. In the short term, I don't see much of an upward potential, right? As I was saying, this region is attracting selling interest, right? You know that over the weekend and earlier this week, there was rumors that Prime Minister Abe was going to delay the hike in the tax sale program for April, I believe, 2017. So that was suggesting the country was doing trouble, and the Bank of Japan will probably add more easing. And yet, in the previous Asian session, yes, news came in saying that there's no delay in the tax hike, so sales tax hike. So that's not good news for the Japanese yen. Not good news for the case of a bullish continuation in this particular case, right? Beware of that. Anyway, I do believe that we need to take 13 towards downside to talk about a bearish breakout, right? And then we can go down to 1240, 1190 is the next support, and 1160, that's the line in the sun, because if we lost 1160, then the pair can go back 100 pips towards this March lows. Okay, as I told you, 1440 region, it's where selling interest has been, so we need to take the levels to go up to 15. But again, 115 is the line in the sign towards the upside, right? We need to take that 15 to talk about further gains. Oil, it's back on the bearish track today, and that should wait in stocks across the world, keep stocks down, right? And probably oil, the gold too. You know, we have discussed plenty of times the fact that despite the price has recovered ground up to those 42, 43 region, the background, right, the macroeconomic background that prices lower all through last year and the beginning of this one, it's still the same, right? Oil production is at record highs, stockpiles are at record highs, economies are slowing down and consuming less. So there's not much of a reason to be bullish in oil, because there's not much of a reason to see the price really recovering ground unless we see production really shrinking and the economy is recovering and demanding much more oil. There's no case for bullish running here. Okay, offer and demand makes it so, and there's not enough demand for the offer the market has these days. Okay, and that's why the price is back down after breaking through 40. Okay, anyway, we are approaching today last week low, which is 38.32 in US crude. I mean, right? We are there. We are breaking below the 20 simple moving average, and the technical indicators are heading lower, still not breaking below their midline. So the bearish potential is there, but it needs to get confirmed. I would say that with a break below 38, we can get confirmation, and the price will probably extend its decline towards this region when we have some intraday highs and low 36.50 around that level. Okay, below this level we will probably approach 35 again. Okay, and 40 sorry, is the first resistance. It's also the 200 simple moving average in the daily chart. And I believe that rallies or spikes above that will probably be seen by the market as selling opportunities. Okay, I'm saying a lot of okays. Anyway, let's go to gold. The commodity has lost momentum and turned lower, right? Particularly with Fed officers' hawkish rhetoric last week, right? You know, once again, it's the same scenario, something that has been repeating for a couple of years already. Gold prices have been following Fed's decisions, right? If the Fed is dovish, right, gold prices go higher. If the Fed is hawkish, gold prices go lower. We had a December rate hike, and ever since, and the U.S. economy slowed down after the rate hike, and the chances of further rate hike diminish. The commodity ran $280 a troy ounce, right? But then, well, we have the Fed saying that the economy is not doing good and being dovish and keeping the commodity on demand, and all of a sudden we have Fed officers saying the contrary, and the price began to ease. At this point, I'm not seeing clearly a bearish continuation in here, but I do believe that there's the risk of a further declines, particularly today, if we had a hawkish challenge. Okay, I do believe that there's a good chance we can go below 1200. I mean, if we have a hawkish challenge, but I would like to see a break below 1190 to talk about a firmer bearish trend in the commodity, right? Still, remember that production cost, it's around 1150. So we are at the base of the range, right? I don't see a $300 decline, maybe 50, 60 bucks, not much more. And then what happened in here when we fell far below the production cost, and the commodity entered in a consolidative stage. Sorry. Anyway, we have some highs around 1225 and lows, right? That's the line in the sun and the short term for the bulls. Because if we can recover above this level, then the commodity will probably regain more ground and probably approach to those 1283 we post mid-March, and the highs for multiple, almost over a year, right? Over a year high. Anyway, 1225 is for middle level. We are talking about the daily chart, so that means that we need at least a daily close above this level, right? And some build up in there before running to buy, not just a test intraday spike towards that level. Okay. I do believe I covered most. I'm taking a look at stocks. I would like to share with you this is the Dow Jones. It's a representation of U.S. stocks. The market is saying, oh, so Dow Jones closed negatively after a 5 weeks rally. The fact is that we are at this year highs. In fact, highs not seen since last late 2015, right? And I don't see much of downward potential. I do believe that the U.S. Stocks are doing pretty good, right? This is so far a consolidative stage, and despite we may see a downward corrective movement, the fact is that we are above the 1 and 200 simple moving average and daily. So overall, this is a bullish outlook, a bullish perspective. Okay, the high this days was set at 17,652 intraday high. So if we take that high, I would expect the down to keep marching towards that 18,000 magical number. Not the same fate for European stocks. I do believe that there's a long way to talk about a bullish continuation in European stocks. In fact, this is the DAX is just representative, but it opened towards downside. It recovered some ground, but still into negative territory. What I'm looking in the DAX is that any attempt to rally beyond 10,000 has been quickly reverted by the market, and that in the daily chart we are still below the 100 simple moving average. So I don't see much of an upward potential until we take out that 10,100 level. Okay, I do believe that European stocks can do that good in spite of ECB's easing. Okay, so beware of that. Beware of the divergences in between European and American indexes. Not something common, but that could happen. Okay. Anyway, I believe that that's it for today. We covered most of it. So thank you for being here with me, and see you soon. Okay, guys. Bye bye.